My name is Barry Rosenstein. I'm the founder of Jana Partners. My background is not conventional for the hedge fund industry. I've been essentially a serial entrepreneur over my career, and I've had many different experiences. I started way back in the 80s as an investment banker, then did hostile takeovers. We're very disciplined in our application of value plus catalyst investing. There's never any strategy drift with us. And essentially, if you're buying companies at very cheap multiples to after-tax free cash flow, where there's some form of corporate catalyst, you're going to make money over time. It may not be every month or every quarter, but over time, you will make money as long as you do your homework, and we certainly do.
The key differentiator for us is that we're event-driven managers with an activist overlay. So we've never wanted to be activist-only portfolio because we believe that that's actually a restrictive strategy. Rather, we wanted to have activism be a part of what we do. It's usually about 25 to 30% of the portfolio, but it actually is an overlay into how we think about everything. So on the event-driven side, we are also differentiated from many of our peers because we're looking not just at announced events, for example, takeouts or mergers and the like. We're also looking at events that we think are likely to happen. And where we can use our activist and ownership-oriented mentality to try to predict what changes are happening in industry and what changes might happen at a company. We're not long only, although we are long biased, and we believe that's a differentiating factor vis-a-vis other activist-only strategies.
Having been an activist for close to 30 years now, I've developed, what I would refer to as a rubric that of 3 criteria that have to be present for every activist campaign that we conduct. I refer to it as V cubed: value, votes, and variety of ways to win. Value refers to investing in a company at a valuation that we feel is attractive and provides a margin of safety irrespective of any activism. Votes means at the end of the day, if we had to push it, we would feel confident that we have shareholder support. And third, variety of ways to win means we have more than one lever to pull to realize value. And so we are very careful to make sure that we're investing at the right valuation, that we have shareholder support, and we do a lot of underlying homework to assure that we do. Before we get started. I don't understand the concept of losing a proxy fight because you should know the answer before you start it. And 3, assuring that we have more than one way to win.
We're doing intensive research on individual companies and securities, trying to identify situations where we can get involved at a discount to our conservative estimate of intrinsic value, and where there's an identifiable catalyst that we think is going to unlock that value. It's a liquid portfolio. And it is a long biased portfolio. It's also a concentrated portfolio. Our top 10 positions tend to be about 50% of our capital. Our top 15 could be 2/3 to 75% of our capital. So we don't really have any interest in smaller positions that can't be impactful. On the short side, again, it's a bottoms up, fundamental, value plus catalyst type of analysis where we're looking for companies that we believe are fundamentally overvalued, where there's something that's going to lead to a devaluation of that company. And it's usually because we think the earnings are essentially on a downward trajectory. And on the short side, we are typically more diversified, a shorter time horizon, and smaller position sizes. I should say on the long side, our portfolio we view as intermediate term, so 12 to 18 months, whereas on the short side, positions could move on in and out of the portfolio much more quickly. We believe that if we are investing in better than average businesses that we're acquiring at a low price, and if the portfolio stays liquid and unlevered, we can afford to take mark-to-market volatility because we won't be forced to do anything foolish or adverse to our long-term interests by selling out of positions on the lows. So our overall approach to risk management is bottoms-up fundamental research, evaluation, intrinsic value cushion on what we own, and then a belief that the upside is likely to come from our positions for market-specific reasons, because there are company-specific catalysts that will unlock value in any market environment. We believe that's a repeatable process, a defensible process, one that can work in any market environment.